Okay, so when we talk about accounts receivable, we are talking about a situation where we have sold our product and we have sold it on credit and we are expecting someone to pay us back at a later point in time. Okay, so we are mostly interested in our accounts receivable. We'll do a little bit of discussion with notes receivable, and I don't care about other receivables. So it's account receivable, notes receivable that we're going to be talking about here in this chapter. Okay. Now, when we report our accounts receivable, we have to report it net of any uncollectible amounts. We are required to take an allowance against our accounts receivable to show what our net collectibility on that will be. The difference between our sales price and what we net think we will collect on the accounts receivable is considered a bad debt expense. Now, first off, let me ask you, why do we offer sales on credit? Paul?
So give people the opportunity to buy things that with money that they don't currently have.
Okay, well, I mean, yeah, we don't want to, if you buy stuff that you don't need on money that you don't have yet, then we have America being great again, don't we? Okay, but that's not quite, we don't want to put them into bankruptcy. But what? We will offer them credit, and that's going to drive the sales a little bit, right? And people are more willing to come to our store and shop and stuff because we know we extend credit, right? Now, let me ask you something, Paul. Do you think that if you let somebody take away your merchandise and not give you money, is there a chance that some people will not pay you? There is not only a chance, I guarantee you that somebody will not pay you. Now, sometimes students say, well, wait, can't it be that everybody will pay you? Will there ever be world peace? No, there won't. There's always going to be something out there that doesn't go right, okay? Well, I know that, you know that, and who else knows that? FASB knows that. The Financial Accounting Standards Board knows that. And so they tell companies that when they take a receivable, they have to recognize the inevitability that somebody will not pay them. And since that's part of a cost of doing business, we take a bad debt expense for that. And we will literally take an allowance against our accounts receivable. Our allowance for doubtful accounts, therefore, is what type of account? Contra asset account, and that's how we'll show it on the balance sheet as a contra against our accounts receivable. Now, they make this point here that bad debt expense is also called uncollectible account expense. I don't know why anybody would call it that unless they were a drunk accountant. What's the uncollectible account expense? The what? The uncollectible account expense. You mean the bad debt expense? Yes. So I like to call it bad debt expense, but I guess it could also be called uncollectible account expense. Okay? All right. Now you come over and you take a look, and we have two methods that are out there. One is a direct write-off. Direct write-off, forget about it. This is not the way to do it. Why am I doing that with the light when I have the pen, right? So I should just go ahead and... Somebody bring a drill to class? What was that? Sounded like a drill. Okay, so what's happening here? We're going to go ahead and take the direct write-off off of there because that is not the correct method. Okay, what we should use is the allowance method. And under the allowance method, at the time of sale, write that down, at the time of sale, we will have to match our revenues and our expenses by taking a bad debt expense and allowance when? At the time of sale. We do not wait until the person tells us that they can't pay us to take the bad debt expense. We take it at the time of sale. It's a better matching. Okay, so we come over and we take a look at the presentation. Question?
So how do we know that the person is not going to pay you?
We don't know. The person who's not going to pay us can be just as trustworthy looking as the person who, would I say the person who will pay us or won't pay us? Okay. The person who's not going to pay us could look just as trustworthy as the person who will pay us. We don't know. We do not know. However, what? We will have experience, won't we, with our customers in the past, and based on our past experience, that's how we'll determine how much we have to put into the allowance, okay? So if you take a look, just to jump forward since you asked the question, This is an aging of accounts receivable. And they group their account receivable by how current they are. So if they're current, they're not even yet due. Notice we only put 2% as what we assume will go bad. If the person is 30 days late, we do what? 1 to 30 days late, we put 4% in the allowance for them. When someone gets all the way to 90 days late, notice we put almost half of what they owe us into the allowance, because the more late they get, the more the chances that they won't pay us. Now you say, well, how do you know that it's 40%? Based on past experience, right? And depending on the sophistication of the entity, they can have very sophisticated systems for coming up with these percentages. I was on an audit of to see how banks take their loan loss, because Congress wanted to know, are banks doing a good job taking loan loss? Why does Congress care if banks are doing a good job in their loan loss accounting, in estimating how much they won't collect on loans?
Well, if they're not reporting the bad loans, that's meaning probably like they're doing something wrong when they are giving the loans, so they're trying to hide that without them not.
Okay, if they're not doing a good job taking the loans, and therefore what will happen? Why does Congress care? Huh?
Congress cares because they might like put legislation to change practices so that we don't have another financial crisis.
Oh, well, you're on the right track. I mean, we were looking at this a long time ago, guys. We were looking at this in case there was a financial crisis out there looming. Was there? Yeah, okay. I guess there was a couple of financial crises looming. Okay, but the fact that you do it won't avoid the crisis. So, but why does Congress care? Why does the federal government care if there's a crisis looming? They pretty much bail them out. In fact, they back the deposits, don't they? Don't they back your deposit up to $100,000 per bank? Okay, the federal government. I mean, 250,000. Sorry, 250,000 per bank. They back your deposit. So what happens? Well, go ahead, answer the question then. Huh? So why does Congress care about the loan loss? Yeah. Huh? Uh-huh. So how will that benefit the federal government if the banks are doing a good job of estimating? Well, what if they're doing a real good job of estimating it? What if they're sitting there saying, okay, we're going to lose $50 quadrillion. Now we know. Why do they care?
Depending on how good the banks do, affects how like their tax revenue, and then if like everyone's doing well, then they can take credit for it and then get reelected.
Yeah, well, getting reelected is why they do everything. But, what it is a risk management, right? Risk management is something where you're going to hit the wall, or you're going to have the accident. The question is, how prepared are you for the accident, right? So they want to see that they're doing a good job. So if there is this inevitable cliff, they're sitting there and they're prepared for it. And it's not like it just hits overnight and then all of a sudden you got to deal with it at the last second or something, right? Okay, so the banks had a very sophisticated process for doing this, in which they would look at how their loans had migrated over years. They would integrate economic factors in there, et cetera, and that's how they come up with their percentages, okay? But regardless, you're going to come up with your percentages some way based on what? Past experience with your clients as to what's going to go bad, okay? Now, once you determine what's going to go bad, you're going to go ahead and you have on your balance sheet your accounts receivable. The amount that you thought was going to go bad is going to show up as an allowance for doubtful accounts, a contra against your accounts receivable, and you will end up with a net account receivable here of 475,000, whatever, right? Now, sometimes companies will just show it net of the allowance this way, okay? But you're going to have to take off the amount of the allowance. Now, the allowance is the credit, so the debit is going to be to our bad debt expense, okay? And we're going to see literally the journal entries that will go into this, because as you know, we're going to always have to know the journal entries associated with these different things that we talk about. So let's go ahead and let's get out of this for a minute. And let's take a look at the in-class example for today, which I did copy and bring with you, and I did have opened at one time. Okay, where'd you go? Chapter 7, in-class example. Of course, it's not there. There's the quiz, but where's the example? There it is. Okay. And okay, so go ahead and what's on the screen is what I'm giving you here. So go ahead and take one and pass them around. I guess I'll go this way since I always seem to go the other way. Any extras? Thank you. Anyone else? Okay. So, what's going to happen here? We're going to take a look at this example in which we're going to have a company that's going to make sales, and during the year they will take a percentage of their sales as they make their sales. Okay? Then at the end of the year they'll look to see what's in their allowance account based on probably an aging of the account receivable like we saw, and they'll determine if they need to make a year-end adjustment. Now, when we look at the practice midterm here in a little while, the quiz here in a little while, like a practice midterm, the quiz here in a little while, we're going to sit here and we're going to see that they are literally going to talk about these two methods as though they never meet. But the reality is that a company would take a percentage of their sales during the year and then make a year-end adjustment for the amount that they determine they're not going to collect based on analysis of their accounts receivable. Okay, so we start out and we have this Buster's company and they have $100,000 of sales, and Buster estimates that 2% of the sales will not be collectible, and we have to account for the uncollectible receivable as a bad debt expense by debiting bad debt expense and crediting the allowance for doubtful accounts. When they prepare their balance sheet, they'll show accounts receivable of $100,000. They'll show an allowance of what? Of $2,000, and then they'll show the net accounts receivable of $98,000 because the allowance is a contra against the accounts receivable, right? Now, that's the balance sheet. Anyone want to try the income statement? What might be the impact on the income statement for this account? Let's get that test out of the way.